Bonds are not getting crushed. Now prove it to you. You ready? Can you handle the truth, my friends? Can you handle the truth? So let's take a look at the VGLT right now. So it's at 11 o'clock a.m. Eastern Time. Market has been open for an hour and a half. We're going to type in VGLT, and it's up. It's up. Oh, wait, here we go. Right now, it's today 64 cents. So 64 cents on 73, but up about close to 1%. Not much, but not quite. 64 divided by 73.29. It's up. What's that? About 0.8%. And there is the VGLT for 1 year. It's getting crushed. It's getting crushed. No, it's not. I'll prove it to you here in just a second. All right, so let's talk about this. The VGLT so far this year is down 17.79%. Year to date is down 17.79. All right, if we go till, let's see, if we go till December, it was at 92. Let's see, the high 93.26. All right, so the high is 93.26, and the low was yesterday. So 93.26 minus 72.38 divided by 93.26. It's down 22% in about 5 months' time. So that's in a full-fledged bear market. It's not getting crushed, though. You want to know why I know that? So check this out. This is just giving back some of these insane numbers it had from 2020 and 2019. So let's just go to right here. We're going to start in 2016. There's a reason I want to start 2016. All right, 2016 is up 1.33. 2017, 8.66. Down. So let me just share with you real quick. We're going to take our trusty calculator, $10,000. We'll start with $10,000 in 2016. Oops, hold on a second. $10,000. Keep screwing it. Hold on a second. If we started in 2016 with $10,000, as of today, we'd have $11,348. So $11,348 is our present value, our future value. We're going to start with $10,000 as our present value, zero payment. We got 2016, 17, 18, 19, 20, 21, but we'll just say 6 years or so. That means we've averaged 2.13%. All right, 2.13%. Interesting. 2.13%. Pretty interesting, is it not? So let's go and look at why we're not getting killed and it's not getting crushed. All right, I'm going to show you. Vanguard long-term treasury, all right, maintains a dollar-weighted average maturity of 10 to 25 years. So I want to show you something. We're going to go to price, or actually I want to go to, where do I want to go? Hold on just a second. I want to go to right portfolio management. Here we go. So let's look at the portfolio, shall we? Got 66 bonds in there. Yield to maturity is 2.6%. Average coupon is 2.6%. Average effective maturity is basically 24 years, which means the average bond is 6 years old. If the average effective maturity in long-term bonds are 30 years, the average effective maturity is about 24 years. That means the average bond is 6 years old. Means the average bond was issued what? Well, 6 years ago, 2015, 16, 17, 18, 19, 20, 21. No, 2017, 18, 19, 20, 21, 22. About 2016. Interesting. So we're going to go to 2016. All right, because again, does that make sense? If the average effective maturity is 23 years, I'm saying 24 years roughly, that means 30-year bonds are 6 years old. I hope that makes sense. So we have to look at when they were issued, which would be in 2016. If we look at what 30-year, remember, this is the long-term treasury fund. Long-term treasury fund. We're going to go back to 2016, U.S. Department of Treasury, and look at what interest rates are doing 6 years ago. 2016, 2.79, 2.83, 2.6, 2.6, 2.7, 2.5, 2.4, 2.3, 2.2, 2.1. Interesting, huh? That's what they were doing. 2.29, 2.23, 2.4, 3. Oops, hold on a second. So basically average about 2.5%. Back in 2016, about 2.5%. What have I always said? I always said bonds are the simplest thing you can figure out. Bonds give you no more and no less. You take $1,000 bond, it pays you, it matures at $1,000. That simple. In this case, 30 years. All right. And every year it's going to pay you, we'll just say 2.5%. Every single year, because that's what the coupon is, 2.5. They're going to do that for 30 years. So 30 years on $1,000 bond, you're going to get 25 bucks of interest every single year. Come hell or high water, the U.S. government, it can't go bankrupt. It'll give you 25 bucks in interest every single year for 30 years. All right? Which means what exactly? Which means you issue a bond at $1,000. That's what you invest in it. You loan the money to the government $1,000. You get $1,000 back at maturity 30 years from now. There's no two ways around that. So we know for a fact your rate of return on this long-term treasury bond will be no more, no less than 2.5%. I hope that makes sense. No more, no less at maturity. Now in the interim, it can go up and it can go down. It can go up and go down. So in the interim, it can go up and down, up and down, and up and down while it's waiting for it to mature. What happens is the younger the bond, the more volatile it is, and the lower the coupon is too. So anyway, what happens here is the maturity, the volatility is way high on the front end of the issuance, and then it gets less and less volatile as it gets closer to maturity. All right? So what happens? We know for a fact you're going to get no more, no less than 2.5% on the 30-year bond. There's no two ways around. That's what you're going to get. No more, no less. So, because again, they issued it for you bought it for $1,000 and you turn it back in for $1,000 30 years later. In the interim, you get 2.5%. That's it. No more, no less. So what we can go back to Vanguard, we can say, well, Vanguard, look at this. If we look at this chart right here, where was it? Was it this guy? Hold on a second. Yeah, right here. So we know we're getting 2.5%. Then all of a sudden, from 2018 to 2020, the bond, I already told you, went up by what, 12% one year and 18% the next year. No, that's impossible. Listen, I mean, it literally happened, but why did that happen? Why did that happen? Well, because of flight to quality, interest rates were being reduced, and everybody and their mom were buying government bonds because they're scared of Corona, they're scared of Trump, they're scared of you know what, man. They're scared of Tom Brady. I don't know. But all they're doing now is we're just giving back those fake gains. Those gains are fake because we know for a fact that a bond that goes up beyond its par value will come below its par value. It literally cannot be more. Let me bring this back again. I hope this makes sense. It literally can't give you any more or less than the 2.5% coupon you're getting. That's all you can get. It can't give you more or less. So if it gives you more in 2018 and 2019 and 20, it gives you more than that 2.5%, it inherently has to take it away from you to put you back at par. It has to. It cannot have it any other way. Has nothing to do with interest rates raising. Has nothing to do with it. I mean, this is what caused this to happen was the higher interest rates, but it would have happened anyway. Even if they would have kept the interest rates low, it would have gone back to maturity numbers, which is $1,000. The interest rates is just a short-term reason why this is happening, but it would not have mattered. So what's happening now? Again, if we look back at this, they're averaging 2.5, 2.5, 2.5, 2.5, 2.5. And then, boom, we have this huge run-up, and then, boom, we have this big sell-off. But all you're doing is you're giving away your gains from the previous 2 years. And I don't think we've ever seen anything like this before, where you got these massive amounts of gains in 2 years previous, and then you didn't get those, and then you lost those gains the following year. It'll be interesting to see what happens next year. So check this out. Let's look at the long-term treasury mutual fund, not the ETF, because the mutual fund has a track record going back to 1987. 1987 was down 3%. The next year is up 9%. 1989 and 1991 it was up 17 and 18%, or 18 and 17%. But don't forget, back then the long-term bond fund, the yields on coupons from the early 80s was like 15%, 17%. So look at that, 17, 17, 17. It's crazy. 1994, the Fed was raising. It was down 7%. The following year was up 30. 1999, the Fed was raising. It was down 8%. The following year is up 19. But this is what's interesting. Check this out. So I don't know what the rates were doing back in 97 and 98. I mean, I know what the newly issued rates were doing back then, but I don't know the level of maturity. I don't know what the average maturity of the bond was. Imagine 20 years or something like that, just like it is now back then. And I don't know what the average coupon was because a lot of those early 80s bonds had fallen away, but I just don't know. But I mean, it's probably 8% or something like that. But the fact that it was up 14 and 13% consecutively, and then was down by 8.66 in 1999, and then the following year just came back 19%. Isn't that crazy? But anyway, and then you can see we got a couple black years right here. 2008 was up 22%, and the following year this is the exact opposite of what normally happens. So this is what I think is kind of happened here. It was like in 2008 it was up. They weren't. They were lowering rates, and yet it was down the following year because it could not mean because it has to go back to maturity. Anyway, so 2008 was up, even though they weren't raising, they were lowering. In 2009, it was down 12%. But you were freaking loving life right here. That's for doggone sure. I think this is what's happening now, is that these last 2 years, you've had such a big run of 14 and 18% with no interest to correspond with that. Again, the yield's about 2.5%, the coupon is about 2.5%. That we're giving back these gains last year in 2021. We're going to do the same in 2022. So we'll be back to kind of where we should be. Actually, right now it's showing we have a 2. So check this out. Not right. 1.81 is not the current 30-day SEC yield. So let's go back to the ETF, VGLT, and let's see because this shows, I'm going to show you something, man. This is pretty interesting. Yeah, that's not right. Let's go to Vanguard. Yeah, see, that's the thing I don't like about Yahoo. I can't trust the data. I can trust the returns. I just can't trust the current year-to-date or the yield. Check this out. 30-day SEC yield, 2.85. Yet the average coupon is what? 2.6? Is that what we said? Average coupon. Yield to maturity, 2.6, which is basically the average coupon. So if the yield is, the current 30-day SEC yield is higher than the coupons, what does that tell you about the price? That means the price is lower than it should be. Interesting, is it not? So while the bond, I mean, when I say it's not getting crushed, it literally is getting crushed, 18%. 18,500 down to 14,600. You've lost, $4,000, 25% or so in the last year. But look at this. The yield, again, 2.85. What does 8 mean? Yeah, prior 30-day distribution. And yet the average coupon is only 2.6. The only reason you get a higher yield than coupon is because the price is lower. Ugh, that's the opportunity right there, man. Telling you. But this is going to get crushed as they raise rates. It can't. It's about right where it should be. I mean, think about it. If you had 2016, we're going to start right there. You had 12,792 in this portfolio. 12,792 is your present value. We're going to go, was it 16, 17, 18, 19, 20, 21, 22. We'll go 6 years because we're not through 22 yet. We'll go 6 is N. Our ending value right here is 14,686. Haven't made any payments. We've averaged 2.32% a year. That's it. And yet the average coupon is 2.6. These are trading at a discount. That means there's more upside than you think because when they mature, they're going to mature at 100. They're below the natural maturity, the duration, or not the duration, the par value of the bonds. And yet, if the bonds keep going down, it's even more of a buying opportunity. And now you're locking in a pretty good sizable rate of 2.85. Yeah, anyway, hope that helps. Love to hear your thoughts. We'll see ya.